if you had invested $1,000 in Nifty 50 30 years ago, your INR returns would look amazing. But in Canadian dollars, not so much. Today, I'm breaking down why I'm moving away my allocation from India's top 50 companies, but I was investing that through an ETF which is listed on the Toronto Stock Exchange, which is called ZID. And before you think that this action of mine is because I'm bearish on India, this is about math, currency, and where I want to retire. So let's get started. Now, before I get into this decision, I'll first talk about what my investing strategy is. I've talked about this in many videos, but in context of this, it's important that I set this context. I invest about $1,250 every single week, and I break this down into 4 parts. One is S&P 500, which is essentially the top 500 companies in the US. The ticker that I use is VFV. That's the ETF that I invest in. That's 40% of my, investing, $500. Another 40% goes into the global technology leaders, which is tech.to. This is like 70% of the weightage is on the top tech stocks, so the mags, the top 7 that you see, and a lot of the other technology players are all included in this. So I'm very heavy on tech. In fact, I'm heavier than this, but yeah, even S&P 500 is a lot of tech. Then I have 8%, which is the topic of this video. I invest about $100 a week. This is all in Canadian dollars, $100 a month, into India large cap, which is Nifty 50, which is ZID. That's the ticker that I use. And then I also invest about $150, 2% each, so $25 Canadian again every single week into the blue chip tech stocks, which is Nvidia, Tesla, Microsoft, Amazon, Google, and Meta. These are the top companies that you see, and that's my allocation every single week. Apart from that, I also invest $100 a day in VFE again. It's just to catch any daily fluctuations because of Trump being in power. That's $100 per day in VFE, and then I also invest $15 a day into crypto. Now, this is my overall strategy, and even though my weekly strategy 8% is India, that's what I want to move away from. And the reason is, there are 3 reasons in fact. The first one is the currency drag that eats into the returns. I'll talk about that and I'll explain that, what that means. The second one is the nature of India's growth story. It's controversial, but hear me out. And the third one is where I want to retire, and that's not India. I'll talk about this one by one. The first one, currency drag. What does this mean? I'll explain you with an example. With real numbers. So in 1995, if you convert like 1 Canadian dollar, it will give you 29 rupees. So that was the currency exchange in 1995. 30 years down the line, $1 is equal to 63 rupees. So it's not the same. The dollar wise, it will remain the same, but in India, the value of that dollar is very different. It's a lot higher. So that basically means that INR has lost more than 60% of its value against Canadian dollar over the past 30 years. That's the amount of money that you lose in currency exchange. That's massive. I'll give an example of, let's say I was here in Canada in 1995 and I invested $1,000 in 1995, but I did it in Nifty 50. So I actually invested in India. So I invested 29,000 rupees. So that's 29 rupees. $1 is equal to 29 rupees. So $1,000 will be 29,000. Simple math here. And the CAGR, which is the compounded growth that I'll have, is about 12%, and the money would be worth almost 9 lakh rupees, 8.68 lakh rupees right now. Great returns, amazing CAGR, 12%. I'm happy with that. However, because of this currency exchange, the 60% depreciation that we have seen in INR, the worth in Canadian dollars, if I were to convert, because I want to retire in Canada, right? So 30 years, if I was retiring today, I would bring all that money to Canada, and I'll have to exchange that at a 63. That's the sticker price that I exchange it at. That's the foreign exchange. That's the exchange rate, and it will be worth about 13,754. I invested $1,000. It turned into 13,754. Great 13x return. However, my CAGR is about 9%. So I lost 3%, and this 3% loss is called the currency drag. That's what it is. And this is a drag that no one talks about. You cannot spend the money in INR if you are living in Canada. But a lot of experts and a lot of politicians in India have been saying that INR can actually appreciate. But I, for one, do not see it in numbers. However, I didn't want to go with my hunch. I actually wanted to research, and I researched for reasons why INR would appreciate and why INR would not appreciate. So I have a case for INR appreciation, and then I have a case against INR INR appreciation, and let's look at what the research says. The first one is high GDP growth versus Canada. We all know that India's GDP has grown by 6 to 8%, whereas Canada's GDP grows by 1 to 3%. Right now, it's not even that, right? So obviously, high GDP growth for India is a point for India in this argument of whether INR will appreciate or not. There's a strong now again, I'll put it with a grain of salt because the inflation is also higher in India. So when inflation is higher, GDP growth is higher. A lot of the GDP is eaten away by inflation. So we can't do like to like because without talking about inflation. But again, still, I would say India would be ahead in GDP, inflation adjusted. Strong service export. So 10% of the GDP, all these services, IT services, a lot of the IT services, a lot of these big companies rely on, Infosys, TCS, all these service-based companies, and a lot of these services are exported, which is a point towards INR appreciation, and it supports INR currency when a lot of, export is happening, especially in services. Lower external debt and rising reserves. We all know that India is going very strong, and the debt is nowhere close to what we have in the in Canada, or in fact in the US. It's even worse. So that's a point for INR appreciation, and then FDI inflow supporting INR stability. A lot of the institutional money is flowing into India for diversification most of the times, but still it's a lot of money that goes into emerging markets, and India is the forefront of emerging markets, especially with all the manufacturing that's being moved from China and all the other places. Now let's talk about the case against appreciation, and the first one is historic pattern of depreciation. Like, I have not seen INR appreciate ever, right? So in 1995 it was 29, now it's 63. In the last 7 months it's depreciated. In the last 1 year it's depreciated. In the last 5 years, you can look at the charts. I won't put it here. There's no 5-year period or even a 3-year period when INR has not depreciated. So history is not with the for argument. The second point here is India runs a trade deficit, especially in energy, when it comes to energy. Now, even though we are exporting 10% of services, but we are actually, importing a lot more. Like India is, I say we, I'm in Canada, but what I mean is India is importing a lot of things, they are importing a lot of manufacturing goods, cars, and energy. A lot of the energy is being imported towards India. Commodity imports are pretty high. India imports 80% of crude oil. All these are reasons why currency depreciates. And all these are reasons why currency has continuously depreciated. INR has continuously depreciated all across these years because this has remained constant. And the fourth point is that INR stability often depends on global liquidity, not just fundamentals. What does it mean? Now, for most institutional funds, India acts like a place where they can diversify their portfolio. They can have a piece of the developing world. They can have a piece of the emerging world. They don't want to be very heavy on the West, and therefore they just want some place where it could potentially grow a lot. Their money can potentially grow a lot. It's a diversification ploy. When there's a liquidity crunch that we saw this year, a lot of these institutional funds actually go out of India. Because when there's a liquidity crunch, you just want to preserve your, initial, the main capital, but all the growth places where you invest, you would actually take that money out. And that's what has happened with India this year as well. And that has happened. You can't debate that because I've seen the distribution of all these funds, like the big institutions, and India is a very small percentage. Most times a single-digit percentage, like low single-digit percentage of their overall investing strategy. So looking at the pros and cons, whether it will appreciate or depreciate, I feel that I'm personally tipping towards appreciation. Tell me in the comments what you feel about it. But I feel against every, a lot of people have been saying it will not depreciate at all or it will appreciate. I just don't see it because of the first 3 points especially. Tell me in the comments what you think about that. And honestly, I know it's just 8% of my portfolio, and even if I invest that 8% into S&P 500 versus India, it will not impact my overall portfolio. Honestly, it will not, right? Because whatever I invest in place of India, and I'll get to that as well, whatever I invest in place of India, that allocation will not go down to zero. I'm not investing in crypto or some crazy stock. If I invest in S&P 500, let's say, it would not increase by 12-15%, and irrespective of what the drag is, let's say India actually does well and 15% without any drag on currency, my alternate would be a 8 to 9% growth on that 8% of my investing budget. It will hit me, but it will not hit me really hard. So again, I'm just putting a grain of salt to this entire video. I'm only talking about 8%, less than 8% of my investing budget right now. Now, before I talk about what I'll invest if I'm not investing in ZID, I also want to talk about the great India growth story.
India emerges as a standout performer in the OECD economic outlook.
This is going to be India's decade. India is poised to contribute as a new engine of global growth.
India will continue to be a young country.
Weightage on India by 1 percentage point.
India remains the fastest growing large economy of the world.
India has shown some very good figures.
India's rapid expansion positions it as an important driver of global economic momentum.
The World Bank has revised India's growth forecast to 7% from 6.6%.
That brings me to my second reason, which is nature of India's growth story and its limits, because I do believe that there are limits to this growth story. Now, let's talk about facts, right? So India's growth story is fueled by domestic demand. It has one of the youngest populations. It is a growing population. It's a massive population, right? So like there's so much domestic demand that even if there was no international export that was happening, like services is exported, 10% of the GDP is dependent on that. Even if that was not happening, India's growth story would remain intact because of the youth and the amount of population and the domestic consumption that it has. 55% of India's GDP is services and 20% of that is exported, which basically means that 10% of GDP, we already talked about this, is exported and it is constituted by services. However, the demand for these IT services in the West is on the decline. And the reason is simple, right? It's all AI powered. So all these companies, if you see TCS, Infosys, they have always been body counts for the West companies to just dump, all the operational work and developers and stuff like that, right? Testers, all of that was happening with TCS, Infosys. They were body count companies that were serving clients in the West or in the UK. But that reliance is actually going down. And we can see that in the results that we have seen in the two biggest companies, TCS and Infosys. They actually make the Nifty 50 as well. Like they are a part of Nifty 50. They make a lot of these exports. TCS, for instance, in the last 1 year has declined by 30%. Like now, BSE, the Nifty has not done that badly. Like Nifty is kind of flat in the last 1 year, but TCS has declined by about 30%. If you look at Infosys, again, it has declined. The stock has declined by about 20%. Their annual reports say it all. That's the reason why the stock has been declining. It's actually showing in the layoffs. TCS has laid off. This is 12 hours ago, which is like 1 day before this video got aired, like 2 days before the video got aired. TCS had laid off 12,000 jobs, in 1 quarter alone. And Infosys, this is their fourth or fifth round of layoffs, and they have laid off 200 employees, 240 trainees have been fired. All this because the reliance of the West on Infosys is reducing, and it's pretty clear. And a lot of it is driven by AI, because AI is replacing humans, and it will replace the humans that are replicable, that a machine can be modeled, to do their jobs. So, and which is, what TCS and Infosys was doing. No offense to if you are in TCS and Infosys, but we see that IT is getting hit a lot. IT jobs are being taken away, and it's not like IT companies are not doing well. I'm not talking about TCS and Infosys here. I'm talking about, like technology companies. They are doing really well right now. You can see that in their reports. You can see it in the stock market, but they don't their stock prices, but they do not need the same amount of people that they used to, and that's the reality of today. The currency drag is likely to be higher if service export continues to decline, because a lot, and we saw that in the case for INR appreciation. A strong service export was a case for appreciation. However, if this starts to decline, which it already is, I'll not be surprised if this number is, it reduces pretty fast. I don't know, how fast, but if it reduces pretty fast, there's a high chance that, again, 1 point that falls for INR appreciation, that'll actually go away. And therefore, I feel that there's a higher chance of depreciation in the next few years. I'm not saying that India won't grow. Don't get me wrong. India will grow because of its population, but it'll be domestic growth. And if there is not enough services being exported, that's a point off. That will increase the currency drag. And therefore, even if India grows at 12%, my returns will be 7 to 9% depending on how much of a drag we experience in the next 20 years. Now, needless to say, this is not investment advice. It's just my observation. I'm not here to sway your decision. Do your own research. I'm just a random person talking about what I am seeing in the market and what I'm contemplating to do. And the third one is where I want to retire, which is a really critical point because if I were to retire in India, it will be a simple decision. I'll be exporting money. Let's say, I'll be putting $1,000, $100 a week, let's say, from and INR continues to depreciate. So today it's 63 rupees, tomorrow it's 65 rupees. So every month that I put money into India, let's say I'm not doing ZID here. If I want to retire in India, I would open a Zerodha account or some, I'll just go through the ropes. It's a very complicated process as an NRI to invest in India, but I'll do all of that because if I'm investing in India, every month, if the currency depreciate, I actually export more money to India. So today $1 is 63, tomorrow $1 is 100, so I'll be exporting more money and I'll be investing that money into India. It all compounds at, let's say, 12%. And if I retire in India, I just go to India and use that money for retirement. So I do not have that currency drag that I would otherwise experience if I want to retire in Canada, because then I'll have to use all that compounding and I'll have to bring that at a pretty high rate to Canada. And that would lead to the high currency drag that I was talking about. So that's where I would put a caveat. I don't want to retire in India. At least that's not in the plans. And therefore, I'm contemplating a move away from investing in India, especially through a fund like ZID. But if you are someone who is not me, who wants to retire in India, your approach could be very, very different. The question is, if I'm not investing in India, what am I doing? Now, one of the approaches that I've been contemplating is, let me just, replace the 8% and ship the 4% into S&P 500, or let me just put the entire 8% into S&P 500. I don't want to complicate this, that's one strategy that I have. Now, there are two other options that I am contemplating. One is XEQT, the other one is SCHD. I'll talk about what each of these does. The first one, XEQT, it's a globally diversified fund. It makes sense, India was my diversification in the portfolio outside of the US, which is I have a pretty US heavy portfolio, right? XEQT would give me that benefit that India, not investing in India is, I don't have that benefit anymore if I don't invest in India. I'm not diversified. But XEQT would give me that. It will be a globally diversified fund. 45% is US, 25% is Canada, 25% is international. That includes UK, Japan, and then 5% is emerging. So I'll have exposure to these markets without having, a lot of the currency drag. It will still be there, but it will be a lot lower. MER, that's another thing, right? One of the reasons, and that's not a big reason why I'm moving away from ZID, but MER, which is the management expense ratio. This is, if you invest a certain amount, there is a percentage, because they are managing the portfolio, they charge a percentage of that investment. And that MER is 0.2% for XEQT, whereas it's 0.68% for ZID. So it's more than 3 times that of XEQT. So that's another reason in favor of doing XEQT versus ZID. However, SCHD is a little bit different. It's a US dividend equity ETF, so it has a composition of a lot of big blue chip S&P 500 companies again, but they are really big companies like PepsiCo, P&G that pay high dividends. And the dividend yield of this particular ETF is 3.5%, and the dividend has been growing since inception at an average of 12%. So it's not just the dividend at 3.5%, it also grows at 12% every single year, and that compounds to a lot. I would get direct USD exposure because SCHD is listed on NASDAQ, so it's listed in the US Stock Exchange, whereas XEQT is again on the Canadian Stock Exchange. If you see my distribution of the $1,250 a week, it's all mostly, except for the max that I do, it's mostly in Canadian dollar. So I'll get direct USD exposure, which I'll not get through XEQT or my current portfolio. And the MER is in fact a third of XEQT, so like a tenth of ZID. MER is just 0.06%, so it's a very, very self-managed fund, not a lot of expenses here. And minus the MER is not what I base my decisions on. Expense ratios are expense ratios. That's fine. It's not a lot in context to the amount of wealth that we are generating. 0.68 is still a lot, but 0.06 versus 0.2, I'm not finicky on that, as long as it gives me the growth. But 1.2 SCHD in my portfolio at least, and that's my thinking. Tell me in the comments if I'm right. I'm a very very focused like growth investor. What I mean by that is a lot of my companies that I invest in, a lot of the portfolio VFE and all that is not very dividend heavy. It's all dependent on reinvesting these companies, reinvesting into their growth, and my portfolio will grow, but it will not give me any dividends. So SCHD would give me that diversification in terms of having like a 8% or a 4%, 5% allocation into a fund which gives me dividends. Now, not necessarily, I'll not be using those dividends, I'll be reinvesting those dividends, but it's just a good diversification for me. The other one is that XEQT, if you look at the distribution of which industries make XEQT, you'll see financial services, technology again is pretty high, industrials, consumer cyclical. Consumer cyclical is Tesla, these cars, anything which is like seasonal, that's consumer cyclical, and communication services, energy. So you'll see that financial services, technology, industrial, consumer, and healthcare, these make the top 5 in XEQT. However, SCHD is completely different. It's more dependent on energy. Consumer defensive are recession proof things like Costco, Walmart, P&G. You need diapers, you need toothpaste. So all these companies that makes all these like consumer goods, that's what consumer defensive is, and it's 18%. And in my current portfolio, if you look at, I'm very heavy on tech, so it will be a good defense to my tech heavy portfolio, even though the returns won't be as sexy as the tech companies, but in the down years, I'll not be as down as well. And that's the reason why, because of this distribution, I'm tipping towards investing the entire 8% towards SCHD. But this can change, this might change, and I might distribute 4% into XEQT and 4% into SCHD. I love to know your thoughts on this, and I'm putting this as a question for you because I don't know what to do here. Do you think that it's a good move to move away from ZID? Do you think that if it's a good move, do you think that I should be just putting it into VFE and forget about it, do S&P 500, or should I be looking at something like SCHD, which gives me a diversification towards dividends, or XEQT, which gives me a diversification globally? What are you guys doing? I would love to know that in the comments below. If you like breakdowns like these, I'll be doing a lot of these in my Sunday videos, which are more detailed, and my Wednesday videos are more like rants, like stuff which is happening in the market, more current affairs. But if you like, these videos, I would highly encourage that you subscribe to the channel. That's a way to support my channel. I don't charge you anything, to do anything on this channel. I don't sell anything. I do mortgages, but even then, I don't take money to do mortgages. It's free for anyone who books a call and gets the guidance, and we get paid by the bank. That's all I have for today. I hope you like this video. मिलते हैं अगली वीडियो में, तब तक के लिए बाय बाय.